Wealth Nation, until you decide that you are going to control your money, someone else is always going to be in control of it. Now, do you think that that someone else is really going to care about your money as much as you do? That's debatable. My name is Carmen.
And I'm Darius. And I think right about now is probably a really good time for us to start taking into consideration exactly what is being done with our money and look no further than the banks. Banking is an absolute necessity that we have, but banks themselves, not so much. So in order for me to illustrate, the idea of how to become a bank, let me switch over to my screen to help me out. How do you become your own bank? Well, one thing we want to understand is that banking is a process. Banks are a business, and businesses are in business just to make money. So as we go through this presentation, what I want you to do is focus on exactly what the banks are doing, not what they are telling you, because the difference between the two is significantly different. And the process is what we really want to study. So first of all, how do banks actually work? Well, in the most simple form, banks are a storage facility for our money, which means that whenever we get paid, our deposits are directly put into the bank. And the banks, just for allowing us to purchase our money there, they pay us a small interest rate. Now, banks also provide loans. They provide loans for home loans, car loans, student loans, credit cards, etc. Now, what we really want to understand as far as what the banks do is that banks charge us a significantly higher interest rate than what they pay us for our deposits. Now, what exactly does that look like? As an example, I have here the fact that you can earn 0.1% on your account. But when you go to get a loan, let's say the banks charge you 1%. Now, let's put some numbers to this. Let's say you have $100 deposited into your account and you're earning 0.1%. The banks are paying you 0.1%. What that means is that you're earning 10 cents. Now, on the other hand, you go and get a loan for the same exact amount for $100 at 1%, you're going to pay $1. Now, again, these aren't high numbers, and it seems very insignificant comparing $1 to 10 cents. But the difference is that you end up paying 10 times more than what you earn. Now, again, I say $100, but let's take all of our deposits that we have inside banks. This comes to billions of dollars that banks have access to. And yes, we may be earning 0.1% in our account, but the loans are significantly more than just 1%. So let's let that seep in for just a moment. Now, what exactly do banks tell us that we should be doing? Well, based on the advertisements and marketing that we see on television and TV and on YouTube, banks want us to borrow as much money from them as we possibly can. So the banks want us to pay them interest while they pay us very, very small amounts of interest. And they earn it by offering us products and services, not only that they charge us interest for, but we have to pay fees on top of that. So what we can learn from just this concept is that banks keep their expenses low and their income high. They keep their expenses low because the money that they pay us for having our deposits on hand is minimal in comparison to the amount of leverage that we give them and the money that they give us back in the form of loans at higher interest rates. So banks are experts at keeping their expenses low and their income high. Now, what can we do? We can copy exactly what they're doing by, again, making sure our expenses are low and our income is very high. And the difference between the two is the amount of cash flow that we have on hand to do some of the things that puts more money into our pockets. Now, the first thing we want to do is have a foundation of savings, meaning that we want to have emergency funds. We want to have funds available so that when opportunities present itself, we have liquid cash to where we can take advantage of it. The next thing we want to do is invest back into ourselves. That means personal development. You may want to invest in learning a new skill so that you can make more money. We are our biggest assets. And how do I know that? Is because we are the biggest assets to the banks. The only way banks get paid is if we pay them. So if we invest in ourselves and personal development and creating more skills, we're able to make more money. And then when we're also able to do is to invest in business. Use the cash flow to invest into some type of business because at the end of the day, banks are a business. And if banks are a business, then we want to create a bank, not a bank. We want to create a business just like them. So we come to this next point of foundational savings. Do you think banks actually save their money in the banks? No. Banks preserve their cash by using whole life insurance. And matter of fact, banks are the largest purchasers of whole life insurance in the entire world, followed by Fortune 500 companies and our government. And why in the world would a bank want to buy life insurance? Well, one thing is the fact that they don't have to pay taxes on the growth because specifically mutual life insurance companies, you don't have to pay any taxes on whatever income is earned inside that policy through dividends. The second thing is the fact that banks have access to huge amounts of cash whenever they need it. So let's say the economy tanks and the banks need a large influx of money. Well, one thing they can do is utilize their life insurance policies that they have billions and billions of dollars of cash value on hand. Now, the next thing that I think is the biggest reason why banks really love life insurance is the fact that life insurance policies with mutual insurance companies are private financial contracts with private companies, which means that they don't have to tell you the fact that they actually have a contract with a specific company. Means that they're free from litigation and they're free from, again, taxes. And if they get sued, this is money that's just off to the side that nobody knows about. Let's think about it. Did you know that banks actually have life insurance policies? They buy life insurance on their key employees and utilize that cash for themselves. Now, what do they tell us to do with our savings? Of course, they tell us to leverage the products and services that they offer. Why? So they can charge us interest and fees just for having access to it. But then they go and do something different with their money. So, of course, the lesson learned here is the fact that you should be copying exactly what the banks are doing so that you can take advantage of the tax-free growth, so that you can take advantage of having access to cash in the event of an emergency. So you can have access to cash to when you want to finance your major purchases outside of the bank so that you can pay yourself back the interest that you would have paid to the banks. And what this would do is this will increase your cash flow significantly because you have access to cash that, because it's with a private financial company, it technically doesn't exist because you don't have to pay taxes on these funds. If your wages were to get garnished because of taxes, they can't touch your life insurance policies. And even in some states, if you get sued, your life insurance are still invisible. It's still safe. So having access to cash outside of what the government has access to is a huge opportunity that we have that we're not taking advantage of. So if you want to understand a little more about how this whole process works, then check out our masterclass below where we go into more detail about taxes. We go into detail about how much the banks have, our government officials, and how it can actually work for you and your lifestyle. So when it comes to investing in ourselves, how do banks go about doing this? Well, the most common way banks make money that is really easy for us to understand is, of course, loans. Our mortgage loans, our car loans, our student loans, our credit cards. Because at the end of the day, average American has less than $1,000 in savings, but the average cost of a house is about $300,000. So if we have less than $1,000 in savings where we're earning 0.1%, and then we purchase a house at, let's say, 3%, that's a huge amount of money that we're sending away from our household that we can be utilizing to create cash flow for ourselves. So at what should we copy when it comes to investing in ourselves? Well, what the first thing you want to do is realize that you, again, are your biggest asset because we're the biggest asset to the bank. So what you want to do is save 6 to 12 months of your living expenses so that in the event of there's some type of emergency or business opportunity, you want to be able to utilize your cash within your whole life insurance policy. Because the nice thing about leveraging cash within inside of a whole life insurance policy is the fact that you can borrow that money and still continue to earn interest, because just like the banks are doing, they're leveraging our deposits to lend us money. Now, even though they're doing that, do we ever see our deposits change? Let's say we have a savings account with $10,000 in it. And when we go and borrow money from the bank, do we ever see our income reduce? No, we don't. And it's the same thing that happens within a life insurance policy. A whole life insurance policy is the fact that we can go and we can borrow money from the life insurance company and still continue to earn money, because the only thing we're doing is leveraging the cash value that we have, our death benefit. We're leveraging that cash so that we can utilize it into some type of emergency or business opportunity that presents itself. Now we can earn interest with this business expense, and we can still continue to earn interest inside of our life insurance. Now, what we also want to do is do a better job managing our money. We want to be an expert at money management. Why? Because the banks are experts at it. And we want to manage our own money, because as soon as we give up control of our own money, what happens is the person that we're giving up control of that money, what's in their best interest is they make as much money as they can for themselves. So what we want to do is control our own money. Understand exactly what our money is doing. Understand exactly how much it costs in order for us to get our new house before we actually purchase it. We don't want to let the banks tell us how much we can afford. We want to go to them and let them know how much money we plan on paying. So all that comes in understanding how to better manage our money and being responsible and disciplined. Now, the next thing you want to do is invest in your personal development, because investing in your personal development and creating better skill sets allow you to make more money. And the more money you make, the more money you're able to keep, because what you're doing is you're taking that difference between the amount of expenses that you are paying. And as your income increases, again, there's more cash flow that you have to invest in businesses. And what we want to think about when it comes to businesses, creating passive cash flow. Now, what passive cash flow allows us to do is make that spread even larger, because the fact that we do the work one time and that money continues to pay us over and over again. And the key word here is control. A lot of times we want to invest in the stock market, we want to invest in mutual funds, but we don't have control of those assets. And the less control we have, the more risk that we have to take on. So right now, the market is doing its own thing. There's a lot of people that are losing money or have lost money, and there's people that may make some money. But the fact that we can't control it is a huge risk for us in generating the income that we need in order to sustain ourselves. So what you should have got from this is understanding exactly what the banks are doing and being able to look at this and apply it on our own scale. And what I want you to do is check out our next video on how infinite banking works, because this breaks down the process of borrowing from your whole life insurance policies and utilizing that cash value to make your major purchases in your life, so that instead of you paying interest to someone else, you're able to recapture those interests and redirect those funds back to ourselves. What I want you to do is own your own lifestyle, or someone else will.